I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Today's episode is different because I'm not talking to an industry CEO, but someone who has made a career of holding industry CEOs to account. Since the turn of the millennium, Ian Gutterman has been analysing the insurance industry on behalf of investors, and in that time has sparred with all the top CEOs and executive teams. Analysts and journalists are kindred spirits. We both sit on the outside of the industry looking in, and we both tend to speak to the same sorts of people, although we tend to ask different sorts of questions when we do. After a while, we tend to seek each other out to compare notes. Journalists seek out the smartest analysts with the strongest personalities and the best communication skills, and get them to explain some of the more technical and academic questions driving the industry. Ian is a journalist's dream because he's incredibly intelligent but also refreshingly direct. Ian has personality and strong convictions in abundance, and in this episode we cover all the big questions affecting the industry today, from when the 15-year bull market for intermediary valuations might come to an end, the wider consequences of the California wildfires, and whether insurers really have a proper handle on cat risk, to whether recent bouts of casualty reserve strengthening are now over, or the lessons from the insurtech boom, and why venture capital and insurance don't mix. Ian and I had a lot of fun on this recording. Listen on, and I think you will too. Enjoy the podcast. Ian, welcome to the Voice of Insurance.
Thank you. Nice to be here. Looking forward to it.
Well, for anyone who doesn't know you, why don't you give us a bit of a swift run through your career to date and how you've got to be where you are today?
Sure. I guess I'm, a unique part of the insurance ecosystem, right? My background is in investing. So I started out at Fidelity, 25 some years ago. And I got into insurance pretty early, right before 9/11. So in the summer of '01. And normally the path you take at Fidelity is you do a bunch of different industries and you become a diversified fund manager, right? And when I was young, that's what I thought I wanted to do, and got into insurance at a very interesting time and found out I was very good at it, right? At the time it was exciting. I know we don't normally think of the industry as being that exciting, but at the time there was a lot of action, obviously, with the class of '01, AIG's reserve problems. I mean, there were a million things going on, right? So I decided to stick with insurance. So I got an offer to go to a hedge fund a few years later. And the pitch was basically, you can do insurance forever. We'll give you money. You invest it how you want. We'll leave you alone. We realize you're the expert. And that sounded great. That sort of set me on my path. And I did that for the next 15 years. And during that time, just because I was very deep in the insurance world, and there aren't a lot of us who really specialize in insurance as investors, I got to have very close relationships with the companies and developed, I guess, a bit of a personality where a lot of people say, I recognize you from the conference call, things like that, right? So
it's a small community, isn't it? I mean,
yeah.
We've got that affinity, I think, or the journalists, we're all part of that same kind of, we're the camp followers of the industry.
Yeah.
We're busy reporting on those results. You're busy putting out your notes on those results. You're going on those calls, talking to the same people that we talk to, but asking them a whole bunch of different questions. But so at Fidelity, you were kind of an equity analyst, and then you were just doing your little stint in insurance and hoping to, well, then you move on to banking, then you do your thing in energy, then you would do whatever, and retail, and,
exactly,
and then consumer goods and all the other stuff. And then you end up running your own fund or something like that, something diversified. But then, like so many of us, you got hauled into the insurance world because it was more interesting than you thought it was going to be.
No, exactly. Well, so as you said, they rotate you into different things. And my very first assignment was essentially transports. And I knew I had double rotation, and they wanted to give me, in the spring of 2001, basically the tech infrastructure. Think all those things that went bankrupt, right? Like the guys laying the fiber, right?
Yeah. What is it? WorldCom and
not even those. It
time.
Was like JDS Uniphase, and
there was a whole ton of money, wasn't there? A whole ton of money was invested in laying cables.
Right. They're the equivalent of the guys building data centers today, right? And they offered me that, and you weren't allowed to say no, but I said no anyway. And I said, that's just not what I'm good at. I'm good at tangible businesses and understanding things. And I knew the insurance person who'd been doing insurance was doing it for a while. And I said, I'd rather wait for something. And as soon as the insurance guy announced he was moving on, I sprinted to the CIO's office that I'll take insurance. And so I actually volunteered for it. Now, again, at the time, they were all trading below book. And I think I owned Markel. If you remember Terra Nova, right?
Of course, yeah.
They blew up on the Terra Nova deal. Markel's trading below book. the prior insurance analyst was talking to me about it. I bought Markel, my personal account, below book. So I knew a little bit about insurance. I read all the Buffett letters, all that. So I knew enough about insurance. I had a math background. I knew I could do insurance. So I actually raised my hand for it. And then it was good instinct because, yeah, to your point, I took to it and decided to stick with it.
It's funny you mentioning Terra Nova. It's just I had Nick Line, who was an actuary at Terra Nova at the time,
Okay.
and he's stayed with Markel through that whole time. So the London acquisition, the London portion of Terra Nova, he's stayed with them. He's still with them. So there you go.
Okay.
Shows what a good company. Yeah, and it's not trading at book anymore. So
exactly, you're right. So I sold that Markel way too early. I mean, I made a good trade on it, but I sold it out a few years later, and I didn't hold it the whole time.
Yeah, I suppose it was one of those ones you should have hung on to. Anyway, you have to take profits in this life sometimes, don't you? Otherwise, you don't get paid. I mean, you can still be holding that original one share of Berkshire Hathaway, but if you haven't sold it,
exactly,
if you haven't made any profit, have you? Just looking at it.
Yes, exactly.
It doesn't give you any income. Anyway, well, now we're back up to date. You're a free agent now, really, aren't you, Ian?
Right. Basically, for a whole host of reasons, I was ready to be done investing. Part of that changes in the market. There weren't as many new things to do, right? You could think how many companies have gone private, how many insurance brokers are private, how many acquisitions there are. There are fewer companies to cover. And there were personal things going on, just nothing serious. I just wanted to spend more family. And, I thought about going to the corporate side. Could I go be a CFO somewhere? And I thought about starting up. So I decided to basically take a break. That was, I don't know, 2017 or 18, somewhere around there. So I decided to break. Then I went to do a startup for a little while, which was a good idea that probably should have worked, but I was just going to get funding. And now I'm evaluating the landscape, deciding whether I want to do something full time or just kind of fun, frankly, doing a lot of things part time. So I have to decide, do I really want to do something full time again, or might I be better off trying to do boards or advisory roles, things like that?
Well, I think any board would be very glad to have you, Ian, have someone with your talents and your experience and that ability to lift up the hood of things and look and see what is inside the machine. You were talking about private equity. Imagine being a UK-based insurance analyst, whereas 20 years ago, you'd have had 25 different integrated Lloyd's vehicles, all sorts of things. And of course, you've got the standard general insurance. They're still there. The Avivas of this world are still there, but consolidated, and obviously Royal & Sun Alliance is not there anymore. And in terms of what's left out of those more international insurance stocks, you've got Hiscox, Beazley, Lancashire, and Conduit that are listed in London. So that's really about it. Forgive anybody if I miss one. Yeah, what about that private equity world? Why don't you go and work in private equity? When we think of how many listed brokers there used to be, I worked for Heath and there was Windsor, but there are lots of brokers that really aren't there anymore. Why has the public market not been the best place for the insurance industry to be? Other than, okay, we had a bit of recovery for some of the stocks, but they were languishing until only about 3-4 years ago.
From new technologies to rising costs, in today's fast-moving insurance market, keeping up with change isn't easy.
That's why the Insurance Network runs leading events for insurers and brokers to tackle strategic challenges, rethink operating models, and unlock the power of data and tech.
Join conferences like TinTech, Delegated Authority Strategy Day, London Market Claims, and the Data Jam to stay ahead of the curve.
You can also join the network for free and take part in focused special interest group meetings on the challenges top of your agenda.
Search TIN Events for the latest schedule of conferences and meetings.
That's tin.events.
Right. It's interesting, to be honest. Again, I have to have a bias, right? But I think in general, most companies are better off being public than private, mainly for liquidity. And within financial specifically, again, part of the reason I think I've been attracted to insurance is I tend to think of the world in probabilities and especially about risk, right? And to me, to be a successful financial company, you always have to be thinking about and understanding your tail risk. And it is much harder to manage tail risk in a private company than a public one. A public company generally has the ability to raise funds when needed. Again, not always.
I suppose if you're too far gone, you're too far gone. And no one's
exactly right. You get the death spiral, right? But in bull markets, being owned by private equity is great, right? No one thinks about what the worst case scenario is. So in a bull market, sure, by private equity, why not? But in bear markets, it's tough because the private equity guys certainly don't want to put money in because they have their own challenges. And you just don't have the ability to go organize that $500 million overnight offering. So when you think about whether it be insurance companies or banks or lending companies, mortgage originators, whatever it is, where they tend to get into trouble is at some point they've laid off too much risk and they assume they never need to take it back.
Yeah.
And something happens in the environment where they can't lay off the risk anymore and they don't have the ability to fund it. And then it's lights out. But, we can go back to unit cover days. We can go back to mortgage companies during 08 and 09. There's always this warehouse risk that gets people in trouble. So private equity, you can make the argument that if you're really with a KKR or a Carlyle or Apollo, they're so big they can get you through that bump in the road. And maybe they will. There's an argument that that part's different if you're truly with one of the Goliaths of PE. But they might just decide they don't want to do that, right? But in a bull market, private equity is great. You can take as much leverage as you want and keep flipping this thing at higher valuations. And it looks like the story never runs out.
And you take more risk on the investment side as well. It always seems to be the part of the playbook.
Exactly.
But I suppose private equity, if we move away from balance sheet businesses, where private equity has really made its biggest inroads have been in intermediary businesses with obviously much less capital requirements. Obviously, every broker and every MGA has an E&O exposure, probably a good idea to have some capital for a rainy day. But generally, they don't need to fund a balance sheet. They don't have to hold that risk on their balance sheet. So we've had this fantastic ride that's built and built over 15 years now. And we kept saying, oh, well, look, some of these brokers going for multiples over 11 or 12, and then it was 14, 15, 17, 18, 19, and then all sorts of newest definitions of EBITDA adjusted and whatever else.
Yeah.
Where do you think this is going to end? Certainly, it seems like a lot of my friends in the media are reporting on it's getting harder to shift this merchandise. Where do you think this is going to end?
I will say, and part of the reason it became as big, right, was you take 15 years. What's 15 years? When around about when zero interest rates started, right?
Yeah.
So when leverage was cheap and the big brokers can only be 2 to 3 times debt to EBITDA because otherwise their public debt rating is imperiled and they don't want to upset their existing debt investors, so they don't want to take the downgrade, right? So there was again, arbitrage isn't quite the right word, but there was financial engineering play. Hey, if I'm private, I can be at 5, 6, 7, 8 times debt to EBITDA. And the debt's because global central bankers are holding down interest rates. I should do this as a private. So that made a ton of sense. I don't disparage that strategy. What I would say is we're no longer at zero interest rates, right? And the multiples have gone to such an extreme that it's very hard to see. We're sort of in the hot potato game now, right? Where there's now fewer buyers and sellers. There's too many people wanting to sell, not enough people left to buy. They can all try to go public. And I think that might be the final answer. But to go public, you have to tell a story. Like if you recall the original Willis public, where they had to come public with a lot of debt and say, we're coming public to pay down our debt. We're a deleveraging story. Willis came public. I can't remember the multiple, but I want to say it was definitely single digit EBITDA. It might have been 6 or 7 times. It was cheap. So it made sense that you can delever and the equity will go up a lot in valuation. But if you try public at 15 times EBITDA and say we're going to delever, there's no story that we're going to go to 20.
And organic growth doesn't come without investment.
Yeah.
You have to spend a lot of money to get organic growth. It doesn't just happen, does it? I mean, it might sound like it does sometimes when I talk to a broking CEO, but of course it happens. There seems to be less of a difference between organic and inorganic growth. I remember lots of broking CEOs over the decades complaining to me. So if I buy a broker that's a great broker and it adds complementary acquisition, they say that's inorganic. But if I hire all the same people and I overpay for those people, that counts as somehow as organic growth, and that's good. I think these days perhaps that line has blurred a little bit more as well. So yes, you'd say it might end up with a whole load of IPOs, but perhaps slightly disappointing ones. And then is it free reign just for the big 3, big 4? Probably should talk about the big 4 these days, given the way the Gallagher's grown. Is it really just for them to sit there folding their arms and waiting to take over whichever one they want?
Well, that's what I've been advocating, actually. I was disappointed, and I have a lot of respect for Gallagher. I'm a 20-minute drive from those guys, so I've spent a lot of them over the years. But I thought they made a mistake with the recent deal, not because it's a good or bad deal. It's just Marsh is tied up, Aon's tied up, Willis isn't going to do anything material. they had the ability to sit back and say, we're not going to do a deal unless it's an amazing deal. A lot of you guys want to sell, and we're at the moment the only buyer. So you want to do it on our terms? We just won't do it. Instead, they jumped. I didn't think they had a jump. I thought they should have sat back and been patient. But now you have the issue with everyone tied up for a couple of years, whatever it is, until they de-lever a little bit.
They've all done a big deal, a big enough deal, haven't they?
Right.
You'd have to focus on the digestion of that deal.
And you have to just bring the debt back down, right? Yeah. So if you're a seller now, what do? You're kind of stuck. So they're going to either have to IPO or they're going to have to wait out these guys being able to do another deal. But again, there's still this more sellers than buyers issue. And you would think at some point, Marsh or Aon would realize that and try to squeeze people. And if there's any sort of hiccup anywhere in the system where something happens that someone can't make a debt payment on time or whatever it is, and the valuations come down across the board because everyone gets scared.
Yes. Well, we had that situation in the UK with Towergate, which is what has then morphed into Ardonna. It was a sort of zombie company for quite a long time, but for much longer than anyone could have imagined, partly because of very, very low interest rates. And then eventually, once it's gone, it's gone. When it's gone, it was a debt for equity swap. The people who wanted to buy what was left bought the debt and then owned the company. And that's how it worked. So yes, nothing happens until suddenly there is a big quake and that's it.
Exactly.
Is that you think where we are at the moment? We're in the kind of phony war situation where nothing's quite happening yet.
I think so, yeah. I mean, it surprised me that it's been in this limbo for so long, but I'd say one broad theme that I've learned over the years is it's usually easy to identify where there are mistakes being made and how it will eventually end in tragedy. What's hard to get right is the timing. The mortgage crisis, there were plenty of us in the finance world that knew the crisis was inevitable and was just when, right? And a lot of people bet it was going to happen in 2005 or 2006, and they lost their jobs because they bet wrong too early. So the timing is always hard to get right. Litigation finance. I remember talking about that 15 years ago with people and be like, oh my God, reserve's going to be a disaster at some point. But it took forever, right? The brokers, the same thing. Like, what's going on? I would challenge a PE to show me an analysis. And I might try to do this someday if I can get my hands on the data. I would love to see an analysis of just show me cash flow based valuation model, not just where 18 times EBITDA, that's where the last one traded, but like actually show me real cash flows, discount rates, all this sort of stuff, cost of debt, whatever it is. Show me how at the current rates of growth and the current multiples you're paying and the current cost of debt, how you can justify 16, 18, 20 times EBITDA for one of these companies just based on cash flow. You can't do it. The only way you can do it is, well, that's what they're trading for, so that's what we do. If you were Warren Buffett buying this privately just to manage it for cash flow, Buffett would never pay the valuation. He just wouldn't. It's at some point that has to unwind.
And just whenever it happens, it will happen. But anyway, we heard it from you, Ian, long before anybody else. So well done. Thank you very much. Yes, but it's not investment advice, anybody listening, by the way. So
Right.
Let's get right up to date. What about the LA wildfires?
Sure.
You've written some interesting things. By the way, Ian writes a fantastic blog, Ian's BNR, the play on IBNR, incurred but not reported, but Ian's but not reported. Well, actually, what does BNR stand for? Is Ian's but not reported?
I have like a few different versions of it. It's meant to be a little bit ambiguous, I guess.
So, you've written a few blogs about the LA wildfires, by the way. So anybody, there's going to be a link in the notes to the podcast. So everyone who's listening should make sure you sign up for Ian's blog. It's fantastic. I always read it. What do you think the long-term impact is going to be? What about the insurability of the state of California? I would say long-term to say, is it the last person out going to turn the lights off?
So California had some very extreme regulations around pricing and goes back to, I want to say 89 or maybe the early 90s. I can't remember, but it's been 30 some years where it's been very difficult to raise prices if you're in California without regulatory approval, which is almost impossible to get. So you're capped at 8% a year. And look, when loss trends were benign, either I'll just take 7 or I don't even need my 7. I'll renew flat. It's okay. Don't worry about it. But then loss trends changed. We got inflation, right? So if loss trends are 15, you can only rate 7. The system doesn't work. And a lot of people, again, it's a little bit like just discussed with the brokers. When things are benign for a long time, companies get comfortable and lazy, and they don't worry as much about what can go wrong as they should. So you had a long period where, frankly, California homeowners' loss ratios were very good for a long time. So there was this false sense of comfort. but you were still losing real pricing. Actually, you were losing pricing every year versus what you needed. So again, the last, whatever it is, 5+ years, trends started to go the wrong way, cats picked up, and all of a sudden we're way behind. And there's basically no way out because you can't raise pricing well enough. Even with some emergency relief being given, you've seen state farms ask for another about 30%, and they got turned down.
Yes.
So the issue is the U.S. state-based insurance system, it works well in many states. But the thing I always like to point people to is when people say we need more regulation or we need the U.S. government to step in or whatever it is, there are 3 large cat states in the U.S., Florida, Texas, California. Texas is fairly lightly regulated. Now, if you look at cats in Texas over the last 10+ years, they're awful. It's not just hurricanes, but there's been tons of hailstorms, tornadoes, things like that. If you add them all up, the cat losses in Texas are as bad as they might even be worse.
When it was freezing in Houston, wasn't it? I mean,
it's a freeze. There have been so many sort of mini cats in Texas, and yet there's no availability crisis in Texas. Why? Because companies were able to raise prices in response to events. It's only Florida and California where prices are suppressed. So these are own goals, if you will, right? They're unforced errors by the regulators that have caused these crises. And the sad part is the insurance companies sort of went along and they caused their own problems, right?
So now we've got a big problem because you've got the fair plan assessment and there's going to be more again. So it sounds like one of these intractable problems. And what I find a bit surprising is, of course, we're not even talking about the main event, although probably from an insurance perspective, an earthquake is not actually necessarily the main event anymore because the take-up rate is so low. I don't really know. But take-up probably is so low now that actually it wouldn't be an event, which is, again, there's always a complete head-scratcher from me. I'm not really sure what California does if there is an earthquake. I'm not quite sure what the banks are all doing either, lending mortgages on very expensive properties and not requiring that they have earthquake insurance. At least in Florida, the bank does require that you have Dematec A-rated paper insuring your house. Otherwise, they're not going to give you a mortgage. I don't really understand where that risk is being laid off unless, it sounds like it's all going to end up in the federal government somewhere, but...
That's certainly a big risk. The CEA, obviously a lot of people end up in the reinsurance markets, right? The CEA buys a fair amount of reinsurance, California Earthquake Authority.
Yeah.
The take-up rate by homeowners on CEA riders is very low, as you said. So most homeowners are uninsured or underinsured. From an insurance industry loss perspective, it's going to be more on the commercial and more on the CEA program. The homeowners, it's fairly light, and we're going to have another public policy crisis.
It doesn't make a lot of sense to me, but certainly from a public policy perspective, but then I don't run California, I don't run the federal government of the US, but I would be slightly worried. Or if I was the mayor of a town and I was in an earthquake zone and no one or only 19% of people had insurance, I'd be pretty worried about my property tax revenues, that I wouldn't really have a town.
Right.
I don't think I would be able to have a town. I certainly wouldn't be able to pay any of the municipal debt. I would have to be in default on that pretty quickly, I would have thought. And then also, how viable would it be to rebuild? If I lived on a street where only 20% of people had insurance and 80% of people didn't, how viable is my street?
Yeah.
How viable is the shop at the end of the road? How viable is the local school? How viable is the post office? There won't be one because they'll say, well, there's no people live here anymore.
Again, this is anecdotal to a few people, so who knows how widespread it is, but I suspect a pattern. You hear stories about people say, I'm not going to rebuild, I'm just going to sell for the land value.
Yeah, but the land's not worth what you think it is.
Well, the land's worth plenty, right? It's California. The land's worth a lot, but they know it's going to take 2, 3, 4 years to get permitted. And these are very congested areas. Think about just getting construction trucks through, right? It's not easy. So, few people get rebuilt at a time. You can't rebuild everyone at once. So people are just going to walk. So to your point, whatever the municipal budget is of that main zip code in the Palisades, they're not going to have the same revenue they thought they will because a lot of people are just not going to come back.
We're getting into a big sort of societal public policy problem here. Yeah. It's a shame because I think insurance, if left alone, would do quite a good job of solving that problem.
That's the sad thing. If you let the market function, one of the big things people miss is Florida insurance is expensive, but relative to actuarial, it's probably one of the most underpriced states in the country. California is not just underpriced, it's actually below median price of insurance.
Again, in your blog, that was a very interesting statistic that actually people in California think they're getting a raw deal. They're not. They're getting very good insurance. Very good price anyway, yes, but
Right.
might
But,
not work.
people still like to complain. You don't understand something. You only know what you're paying. It's behavioral finance type stuff, right? You anchor off what you're used to, and you don't have the perspective to know it's a good deal. Something goes from a good deal to a less good deal, and you think it's terrible.
Ian, you mentioned our other favorite dysfunctional, not always dysfunctional, but sometimes more functional than others, state in the US there, Florida. Confidence seems to be returning. Is that misplaced confidence? Is that actually justifiable, any of it? I mean, we've got some new startups, we've got a nice era of depopulation of citizens. We've been here before. Where do you think we are? And by the way, do you think the wildfires will have tempered a little bit of the appetite for catastrophe risk and would affect that wind market?
My instinct is not as much as it should, it still feels like 6-1 will be down. It is different players to some extent, right? You have so much ILS, and if those ILS guys aren't playing in California fire, then their capacity is unaffected and they still want to grow. But were the litigation reforms a few years ago good? Yes. Is that a reason to feel somewhat better? Yes. Does that mean companies should be cutting pricing and citizens should be cutting pricing? Absolutely not. It's just insane that citizens are cutting pricing, right? I understand it's political. Again, it's not
actuarial, no.
Right. But it's very premature declaration of victory because actuarially, everything's still underpriced. And the whole system, everyone likes to focus on citizens, and citizens is very important.
You've written extensively about the Florida Hurricane Catastrophe Fund there, which is obviously the state reinsurer.
The CAT fund, I mean, you'll understand, the CAT fund is basically like the Central Fund of Florida. Everyone's gotten free leverage out of the CAT fund, or very cheap leverage. So if the FHCF goes, no one else can renew their business as is because they don't have enough capital. If you remember the doom spiral after 9/11, that the Central Fund was going to collapse at Lloyd's, and Lloyd's was going to go away, right? This is basically what's going to happen in Florida, and their situation got worse last year. So unless the state's willing to throw a lot more money at it, in which case all these Florida depops don't have the reinsurance they thought they had, which means Demotech has to pull their rating, which means it's game over. So it's sort of like when you see an inflection point, but you're all the way at the bottom, you see a little inflection off the bottom, and you think that means you're all the way up at the top, right? It's a local top. It's not the peak, right?
The dead cat bounce.
Right, the dead cat bounce, exactly, right? So I would still be very wary. I still think there's a lot of risk in the system. And the reason people form more startups is because, again, it gets back to incentives that don't make sense.
You're looking at the real big picture. You've written some interesting things. It was very eye-opening, the Verisk study late last year, very interesting about expected annual average losses and kind of global PMLs, and particularly obviously looking at the US market being half the world's market. Do you think we're underestimating cat exposure still as an industry? We're talking about exposures and just the annual expected loss going up by 50% in 3 or 4 years.
Yeah.
Are we really pricing for this?
I think we're starting to close the gap some, but no, it doesn't feel like we're fully pricing for it. Even when you would talk to companies about how they thought they would grow book value over time, we're basing our bonus payouts based on growing book value at X% over the years, whatever. And I would always ask, well, what's the cat load embedded in that? And they would say, oh, well, our cat load is whatever it is, 5 points a year. And okay, I get that, but is that your mean or your median cat load? Because I get when you're trying to get Wall Street analysts to come up with consensus earnings, you use 5 points. And that might be the most common, but normally what it's going to be is 2, 3, 7, 4. Those are going to be at 20.
Yeah.
So when you really average it out, your cat load is really 7 or 8 or whatever, not 5. If you're trying to figure out growth in book value over time, which is what you say you're compensating your management on. So it doesn't seem like you're using the right load, which is why you're going to miss your target. I actually tended to have 2 sets of earnings models. I had the one for what everyone was going to essentially price companies off of. And then I would put in a big cat every 5 years. And I didn't know which year, I just would throw it in. Once every 5 years, I'd throw in a bigger cat so I can get more realistic book value estimates. I don't think most companies actually do it that way. But if you're really trying to forecast what you think your future book value growth is, and frankly, do you have enough capital before you go do all this share buyback? Do I have enough capital to afford that? You should probably be modeling that, right? Here's the best example. Irma. You remember when Irma was heading from Miami, everyone was freaked out.
Yeah.
There was a investor call around that time. And obviously everyone's asking CFOs, what happens if Irma hits Miami? And I expected everyone to say, well, We plan. We have a 1 in 250 PML.
It's going to be 23% of the shareholders' funds or whatever.
Right. And we'll lose that 23% and then we'll be trading forward the next day. And my question was, well, okay, so you lose 23%, but you still have to have enough capital for another 23% the day after. And most of the companies, they said, no, we don't do that. We'd have to raise capital. What do you mean you have to raise capital? Miami 1 in 250, this is literally what every CRO should be planning for. How do we get through the 1 in 250 Miami? And your answer is you have to raise capital after I'm going to sell your stock down 50%. You're going to tell me you're going to raise capital. That's your answer? I would say the majority of reinsurers, that was their answer. That was just stunning to me. That tells you that they don't really believe the 1 in 250 Miami will ever happen on their watch. Maybe they think the 1 in 100 will.
And obviously, it's the key to success. If you're quoting the next day as a market, having that appetite the day after the big one is how you burnish your reputation, and that's how you make money as well. So yes, if you don't have a plan to do that, then yes, probably it's not great.
What's made RenRe is that RenRe has always had enough capital to trade forward the next day.
Absolutely.
They're the only reinsurer in the world I can think of that's never had to raise defensive capital.
Yes, it's mostly been aggressive, hasn't it? It's mostly been, hey, the market's changed. We've got a really good opportunity. Here we go.
Right.
And it's not been the other way around, has it?
Yeah.
Talking about other defensive moments and painful moments for the insurance industry on the casualty side, Ian, we're coming through a sort of time of reckoning for past sins in the casualty world, particularly US casualty. Where are you standing on this debate? We just had a few outliers, or do you think there's still more to come? Of course, you were born into that era when there was a lot of red ink from casualty, as well as everything else, obviously. But that 2002, 2003, 2004 years, there were still casualty sins being atoned for, weren't there, in every quarterly statement, pretty much.
Exactly.
So you've been born into that world. You've kicked the tires a lot. Where do you feel we are? We've had a few outliers. We've had some quite big numbers, some big resets. Is that the end of it?
I'm going to guess no. Full disclosure, I don't do the kind of reserve detail I used to do where I'd really have a strong view. But I can tell you, you recognize when the movie sequel is being made, right? And what's interesting, I thought more people would have taken true ups at the end of last year, right? You had the perfect excuse. It was a heavy cat year, but otherwise we had good earnings. Let's go sock some away so we don't have to deal with it in the future. What's interesting to me is it feels like, for the most part, people have their arms around pre-COVID. I'm sure we'll still see bleed, but it feels like we didn't have anyone that I can recall new come along and say, wow, we were really behind on 2017. Generally, when you talk to people, you sort of get a feel for, this probably isn't over at 2019. It probably is going to go into this decade too. Right? You started hearing that stuff, and that might just be people who are too cautious. I don't know. But when you start hearing that talk, generally people tend to be slow to admit when things are going bad. And again, when you see Swiss really pound their recent accident years, Everest really pound those recent accidents, we really think it's just them? Really? I just don't believe that. And if you look back, 3-5 years ago, that's exactly how it happened on the 15 to 19 years. A few people went first, everyone else put their head in the sand, and then a few years later, they all come around. So it does feel we're going to end up talking about, 2020, maybe not 2020 exactly, the COVID year, so 2021 through 2023, or even 2024. We're all still short. We had the picks too low, and we got to catch up. Which means, is 2025 adequate? Maybe. I don't know. It should be, but maybe not.
Well, again, you heard it here first, and this is obviously not any kind of investment advice, Ian, but I really appreciate your view on that. There's so much stuff going on in amongst all these other things. We've had an amazing phenomenon in the last 8 or 9 years of being the growth in hybrid carriers,
right?
Capital light carriers, corralling groups of MGAs, and then directly connecting them to reinsurers, but retaining certain amounts themselves, giving them a bit more stability on the front end to those MGAs, sort of maybe giving them 4 or 5 year deals, that kind of thing, the sort of deals that wouldn't have been able to get before. How do you view that? Again, this has been a really interesting phenomenon.
I mean, again, it's similar to the private equity comment earlier, right? It's great to be an MGA when there's tons of reinsurance capacity and everything's cheap and you don't have to worry about tail risk, right? But when I think about where financial companies get in trouble over time, it's when that balance sheet goes away. The CDOs with the mortgages. They couldn't lay it off on that anymore to keep their own risk. All of a sudden, no one wants to give you a mortgage. The same thing happened back in the 90s. Again, on the banking side, we obviously had it with the original MGAs back in the late 90s. So these things tend to go in cycles. And when the cycle's good, everything's great. But I wrote a piece, several years ago back on the InsurTech stuff where everyone was an MGA and they were all going to lay off 80% of their book on reinsurance. And you started adding up their growth plans and how much reinsurance they'd all have to buy. There was no way there was enough capacity in the market to meet those needs. So there is an issue. And my guess is, even if as the InsurTech stuff has come in and not just traditional MGAs are replacing it, if you look up everyone's cumulative reinsurance needs, either reinsurance pricing has to go up a lot because reinsurers are going to dedicate more capital to this, or there's going to be a realization that we need to start taking this on our own balance sheet. So I get that people like to think that the MGA is this magic trick they figured out that works forever, and these dumb sucker reinsurers are going to write our business for us. It works until it doesn't work anymore.
As long as everybody in that chain makes money, that's fine.
Right.
And if they keep making money and they're making a fair return on the amount of capital they've had to invest into that equation, and obviously the risk taker has the most amount of capital to service, so they ought to get a fair share of that return. Otherwise, they won't be around.
But the reinsurers aren't exactly crushed, right? So it's not like you can say the reinsurers are thrilled with what they have. So in some cases, but not certainly across the board.
What about that argument that in this interesting technological times, that because you can remove all the friction,
right?
Back in the old days, you had to be an underwriter at an insurance company, you had to big treaty, everything was done by paper, a lot of brokerage, a lot of frictional costs. And if now you can do everything electronically, and that dollar from the mom and pop can go straight through, and a very high percentage of it can still end up with Munich Re somewhere around the world.
Sure.
Then you can disintermediate and you can give all the parts of the value chain their fair reward. Right. So that underwriter doesn't need to have the balance sheet. They don't need to work for the balance sheet company anymore. They can start their own. They can just be a skilled underwriter and just do the job of skilled underwriting, and therefore be paid for how skillful their underwriting really is. Is that fair? And I suppose that will be sustainable if it makes money.
I think it's fair. The challenge is I don't think you can argue all parts of the value chain are being compensated adequately, right? Like, it's a little bit like the old boys, right? Where, you knew how to buy cheap reinsurance, and, they would arbitrage the reinsurers. You know what? You guys shouldn't be making crazy returns while we're making 10. We want 15. We want 18. The tilt is much too tilted. It really is very much like those old boys days, right? Where the guys who would write those net books and do the arbitrage made a lot of bank, and the guys backing them ended up on the short end.
It's just a fair competitive ecosystem. And in the end, if you are a wonderful underwriter and you're adding huge amounts of value and you have a very, very low loss ratio, and your capital provider suddenly comes and says they want more, then you can go to your own capital providers and start your own balance sheet, can't you? And say, well, I don't think that's fair. I think we can make 15 across the cycle because we're very skillful. And they could go and get their own balance sheet, couldn't they? And say, well, if the reinsurers behind me are asking for too much, I'll go and do it myself then eventually.
Yeah. No, I've been a big advocate that, frankly, the best long-term model is the hybrid. If you remember the old HCC under Stephen Way, right? Like, part of the business is MGA and part of the business is balance sheet, and we can go back and forth. And I'm surprised we haven't seen more of those. Again, I get in easy money times, why not just be the MGA and take all the chips off the table? But if you're really trying to be thoughtful and think about building a business over a cycle, I think that hybrid structure is fantastic. I know people have captives today, but they're small captives. They might take 10%. I mean, a real captive with juice. A, it gives you leverage with the reinsurers to say, if you don't do better on pricing, I'll take more for myself. But B, it also does give you that break in case of emergency. I know I've got a fail safe. So I actually think the best model, if you were really wanting to maximize returns over a cycle, a quarter or a third should be on your own paper and 2/3 as the MGA. That feels like the right mix. Maybe when capital gets a little harder to come by, people pivot to that. Right now, money is too cheap. Why not go full MGA?
But the other big macro cycle has been business moving out of the US admitted lines market into excess and surplus. Where do you think that's going to end? We've studied this long enough to see that there's an element of cyclicality in terms of, in a hard market, more gets dumped out into the E&S, and then a lot of it regresses back into admitted when things soften and everyone's feeling happier and their risk appetites have grown back again. How much this time there's a lot of talk about this being more secular, or more of it being more secular, just because things like cyber it looks like those are classes of business that are probably better suited to being excess and surplus and be able to be more nimble and be able to react more quickly to ratings and not end up in that kind of California trap that we've mentioned earlier.
What's interesting is if I were a state regulator, I would think one of my goals would be, I want more business on admitted paper and less in E&S. I've never heard a state commissioner talk that way. California and Florida, personal lines is going to end up mostly in E&S over time. It's obvious solution, right? Is no one wants to write this in admitted. Again, it's frankly stunned me that there's some, but that there hasn't been a meaningful effort of the sort of usual cast that we're used to that comes and does billion-dollar startups, that no one's come along and said, I'm doing $1 billion personal lines E&S startup, and we're going to be able to charge way above what California lets people charge. We're going to actually have tons of business because everyone needs our paper. So it surprised me that they're regulating other things, and the natural response is there's less admitted capacity available and people go to E&S. So unless there's a regulatory change, it feels like the trend will continue. I'm not sure it's the best thing for the customer, right? If I'm the customer, most of the time, I probably prefer admitted paper to E&S paper. Now, again, there might be something where I have unusual needs and the admitted doesn't do it for me, so I want the E&S. But for the average customer, if you're property in a strip mall or something, you should be able to get admitted paper. You shouldn't have to get kicked out to E&S. I'm not sure the customer's winning from this, but until something happens where they realize that and put up a stink, I'm not sure it changes too much. It does feel like the trend probably continues. It's probably gone further than it should. Again, there's obviously some speculative excess in there. It feels like it takes something regulatory to flip that back.
Yeah, so it's really the regulators sort of being too tough, and then they might end up regulating nothing because no one's going to be domiciled in that state.
Exactly, right.
That's the classic regulatory problem, is I can be the toughest, most perfect regulator and regulate for every eventuality and have no failures, and then suddenly realize that actually no one's not domiciled here anymore.
Exactly,
so I'm going to want to regulate. So you think it will ebb and flow, though? Do you think it's likely to flip back at some point? And how much of what's flowed into E&S might stay there because they like it?
So certainly, if you're looking from the insurance side, certainly the brokers like it being in E&S. The carriers like it being in E&S. So certainly there's an incentive to try to get the customer to take E&S paper if there's a justification. So the question is, what surprised me, we haven't seen more of the sort of standard primaries. What we used to see the cycle expand and contract was whoever you want to pick on, Travelers or Zurich or whoever, would decide, well, we used to clip out into E&S, but those results have been pretty good. We'll put it on admitted again. We haven't really seen that. What we've seen is more of those guys write it on their own E&S paper. At some point, will they decide, we'll take the chance to put it back on admitted? I would think so, but I would have thought that 3 years ago if you asked me, and it hasn't happened. So I'm not close enough to their internal thinking to say, have they really learned their lesson? Or have they just realized we have our own E&S subs now and it's more profitable for us to do it this way? I'm not sure which is the answer.
So it sounds like if you're an E&S writer and you're sitting in London in Lloyd's, for example, looks like the flow is still going to be reasonably good.
It certainly feels that way. And you might not want to write it necessarily, right? At some point you might say, the pricing's not good, but I think the flow will be good, yeah.
You mentioned before about InsurTech, and this is something you spend a lot of time studying.
Yeah.
But let's say all that excitement of, say, 2016, 2017,
right.
2018 is over now. What's the kind of scorecard and what's your learning from that experience? Again, it's interesting how fads come and go. Everyone was going to be an MGA because they didn't want to be a balance sheet business. And some people are, obviously. And then, of course, I can't move for people talking about embedded in the last couple of years or parametric. Yeah. And it's a bit exhausting, frankly. I'm not sure how you can embed insurance into everything. And anyone who's hired a car anywhere in the world, that's what embedded insurance looks like in its ugliest form. I think, all the, collision damage waiver, zero excess option, which always costs more than what the car costs. But, it drives me crazy. I don't know about you, but if that's what embedded insurance is going to look like, I'm not that excited about it. It's long-term prospects. What's your scorecard on, let's say, I don't know how much money has been poured into this enterprise. What do you think we've learnt from it, and what have we had to show for it?
Yeah, just quickly on the embedded, I've written about that in the past. I'm very cynical about embedded. The one thing I'll say, and maybe this is actually a good way to start it, is a lot of the startup models come out of what VCs think are potentially good, profitable businesses if you were starting an insurer. That doesn't mean that they're logically sound. So sure, if you can make embedded work, sure, that might be a more profitable model than using an agent. I get that, but they also don't understand that people have done versions of embedded for, I don't know, I could probably go back 50 years. And my guess is if I went back
Well, I had
100,
Assurance on the show, which have been doing it forever.
right? So it's not like it's a new idea. They think it's a new idea. They think they're applying it to new things, but most of the things they want to try to do it with have been tried before and failed. And there's a reason for that, right? Which is all the sticky things about insurance they don't understand. But usually, again, it's the same reason there's been MGA, it's the same reason reciprocal. Some banker or VC or whatever figured out reciprocals make high returns. That's great, but not everyone should be a reciprocal. That's a whole separate topic we can talk about if you like. But reciprocals, if they work well, are a great idea. But there's a lot of times where reciprocals are a really dumb idea. So they tend to come with these really simple concepts and think they can apply them more broadly. And that's where we've seen a lot of things that haven't worked. But I just say in general, the biggest lesson of InsurTech is the most obvious one, which is this industry is incredibly hard and incredibly complicated, and you need to be a domain expert to know how to succeed in it. And all these people who weren't domain experts came in and thought they had answers and found out that they didn't know what they were doing. That doesn't mean, by the way, just to be clear, it doesn't mean if you worked in insurance all your life, you know how to be an entrepreneur and create a good insurance company. There's a medium. Part of what I was able to do is I was inside the insurance world and outside it at the same time, where I had a good sense of where those boundaries were and what changed, but what shouldn't be changed. So I would only tell back in my working days, I was always happy to go tell a CEO, you guys keep doing this the wrong way. You need to modernize something. Whereas the opposite with the InsurTech, I would tend to tell them, you have no idea what you don't understand. It's all wrong. You need to respect the insurance industry's expertise. And no one's sort of found the happy medium of, I know where the skeletons are, and we're going to go after those. They don't even know that there are skeletons, and they're trying to fix things, right? There's just a lot of written on a napkin business plans that just, in the crazy environment we were in, got funded, right? And it just didn't make sense.
No, I suppose when things don't make sense in insurance, they can last for a while, but they tend to stop making sense after a while and stop doing business after a reasonable amount of time. So we're probably at a maturity phase, would you say?
I think so. My guess is if you remember like the lesson of the tech bubble, right? Like Google came late. Google came after the tech bubble, right? So there will be somebody who inevitably sees everything that's done and comes out with a more sober way to do things. The challenge, I think one of the other misunderstood challenges about InsurTech is, and I suspected this from the beginning and I learned it was true, the VC model and insurance just do not work. They're oil and water. VC should not be in insurance. It needs to be private equity. Right? If you think about sort of what you call pure and InsurTech, you can argue they were, right? They were successful because they had PE backing, not VC, I would argue.
Yeah.
But I think things need to look more like that, where you get PE. The problem is PE has gotten so big that PE doesn't want to do, maybe HomeState's a good example, right? HomeState, I can't remember how big they were when they started, but I believe it was under 100 million. It wasn't that big in the beginning. But there are things like that, you know.
They're too small, aren't they? I suppose they're too small to move the dial for the PE company.
Right. So they don't want to start those.
Yeah.
Right. They don't want to start a 50 or 100 million insurance anymore. They want to do $1 billion. But if they're going to do $1 billion, a PE can't do something speculative that looked like an InsurTech because it could go to zero. PEs don't want to do something that could go to zero. So PEs would rather do another reinsure with the balance sheet, which they don't even want to do those anymore. But it's very hard to figure out how do you actually get the ideal funding, because it needs to be something that has the mindset of PE, but is also giant from the beginning and can't go to zero. So I don't think anyone knows the answer to that yet. Until we find that answer, I don't think we're going to see InsurTech really work out.
Well, that's great. Ian, I've really enjoyed talking to you. It's been fantastic. Thank you so much for all your time and for having such considered and interesting opinions on so many different topics. I really, really appreciate it. Thank you so much.
Thanks. I'm glad to do it, Mark, and happy to do it again sometime.
Absolutely.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com
to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.